Even if they are profitable, even if there's more cash flow, have valuations still been elevated, more elevated than they should be, considering interest rates are rising, there's more inflation?
A bit, but not much.
Okay.
Let me give you the exact data on that.
Please.
If you look at the public profitable index of software, which is not the majority, it's a small piece of it, it peaked on average at 25 times EBITDA. Think about that. Now it trades for 18 times EBITDA. So sure, valuations are down with higher interest rates and all the turmoil that's going on in the market. But those changes are more like what's going on in the broader indices, okay? If you look on the other side at the unprofitable companies in software, look at the pain. They peaked on average at 17 times revenue.
So are you staying away from?
They're at 5 times revenue today.
Are you staying away from unprofitable tech then?
No.
Okay.
That is exactly what we buy. And I really want your viewers...
Isn't that the danger zone, though?
Well, I really want your viewers to understand how private equity works and how we do it at Thoma Bravo. And I even see these questions on Twitter and in different places. They go, but weren't you buying a company that is break-even or unprofitable? Yes, it was, before we bought it. But what we do is we buy these great innovators that are growing, that we feel are the highest quality, that we feel are market leaders. And then the day we close and thereafter, we turn them into profitable private equity.
You're betting on the growth then. That's the private equity story. You're betting on the growth. I definitely get that. But this mathematical exercise where you have to discount the future cash flow, just as a mechanism of that, should investors be prepared for a world of lower returns?
It's so interesting discounting cash flows because tech has gotten hit because of that, partly because of that discounting future cash flows. But those future cash flows were never meant to exist anyway, because the companies were not making any money. Now, it is true that when you turn them into high cash flow machines, you do have to discount those cash flows at a higher rate.
Right.
That lowers the value. But on the other hand, think about inflation. Software is a productivity tool. So your software product is worth more the higher the rate of inflation because it allows you to accomplish more with the same labor.
So is your bet that these corporations, they're still willing to spend, these companies that you're investing in, they still have pricing power?
They definitely have pricing power if you buy the right one, because what you're doing with them is you're able to do the same amount of work with less labor or do more with current labor, whether it's knowledge workers or not.